Hi there, it's Grant here and welcome back to the Fast Track Options Trading Challenge. We're really starting to motor now because we are now on video 4, which is understanding put options. So in the last video, I took a closer look at call options, the various call options you can make and how you make money with them. But now we're getting into put options, the two different types of put options you can take out and how you make money with them. So with that said, hang on to your seats and let's get going. So let's just recap what a put option is. So a put option gives the options buyer the right but not the obligation to sell a stock at a specific price by a specific date. So let's just look at this example. So say for example, Simon, he's decided to buy a put option. So in exchange, Simon's the put option buyer. In exchange for $15, Simon has the right to sell StockX for $100 per share anytime before December 30th. So let's look at it from his side of the options contract. So he pays a $15 premium to Chloe, who's the put option seller. But that, by being the option buyer, has the right to sell StockX at any point to Chloe at $100 per share before December 30th. In return of selling the put option, Chloe collects a $15 premium from Simon up front as cash in her pocket so she can spend that how she wants. But also for collecting the money up front, she has the obligation to buy StockX from Simon for $100 per share if he decides to exercise the put option. So let's look at the trade from both Simon and Chloe's perspective. So buying a put option. So Simon's buying the put option. So in this example, Simon's buying this put option because he thinks StockX is going to fall before December 30th below the strike price of $100 per share. He thinks it's going to be down here somewhere. So the strike price is basically the point at which Simon can, is the price where Simon can basically sell StockX at, which is $100 per share. So if basically StockX rises above, the strike price, which is $100 per share, this isn't what Simon's betting on or wants. If it rises above it at or before December 30th and keeps going up and doesn't drop below $100 per share, he's going to lose money, so he'll just let his put option expire worthless and he'll lose the money that he paid for it, which is $15. However, if the price of StockX drops below the strike price of $100 per share, Simon's going to exercise his option to sell StockX, because why wouldn't he? Say, for example, if StockX is trading at $50 per share, of course he's going to sell it for $100 because, he's going to make 50. His profit's going to be 100 minus the current market price 50 minus what you paid to take out the option. So his profit's going to be $35. So what you need to understand, anything down here below the strike price is profit, because basically Simon can sell StockX for more than what it's worth on the open market. So that is why Simon is buying a put option, and that's how he makes money with it. So let's look at this trade from Chloe's point of view. So Chloe is basically betting that the price of StockX will go up. Now, if it goes up, basically which Chloe wants at any point before December 30th and stays there, Simon's not going to exercise his right to sell StockX to Chloe, in which case he'll let it expire worthless. And then basically Chloe walks away with $15 in her pocket. Winner, winner, chicken dinner for Chloe. But obviously, if the trade goes against her and StockX falls below $100, which is the strike price, in which case this is the point where Chloe's obliged to buy StockX from Simon. If it drops below that, Simon's going to execute it, in which case Chloe is obliged to buy StockX at $100 per share from Simon, in which case she's going to make a loss if obviously it's trading at any point down here. So say if StockX drops to 50 and Chloe buys it for 100, you know, she's going to be 50. She's going to make a loss of $35 if it's trading for 50 on the open market, but she has to buy it for 100 minus what she collected for the premium, which is $15. So basically anything above the strike, Chloe makes money because Simon will exercise the option. Anything below, Chloe loses money because Simon's going to exercise the option and force Chloe to buy from him $100 per share. So that is basically why you'd buy a put option and why you'd sell a put option, and basically how you can make money with a put option, buying a put option, making money with selling a put option. So that it basically wraps, you know, sort of why, you know, understanding call and put options and why you take them out and how you make money with them. I know they're simplistic examples, but I'm just hoping that, you know, you're beginning to understand what call and put options are, why you take them out, and how you can make money with them. I know this can be a bit confusing in the beginning because, trust me, when I started looking into options as a viable way to make money trading, it was really confusing to me, you know, because, you know, you're dealing with, rather than dealing with buying and selling shares, you're dealing with contracts that control shares. So, and there's there's all sorts of different things you can do with it. But once you understand the basics, the whole concept of options becomes easier, and how to make money with them becomes clearer. So we're really starting to motor on now. In video 5, I'm just going to run over when, you know, deciding when you can use a call or put option. I'm just going to look at that in greater detail. So I'm really hoping you're enjoying the challenge. Why not like the video if you liked it? Share this video with your friends, or the whole challenge videos with your friends. Why not subscribe to the channel to be notified when these videos come out, or just to get more content with us. What I'm going to do is in the links below, I'm going to link to my favorite financial advisories. Both of these advisories give professional options trades. So, because obviously one of the biggest issues as a new options trader is which stocks to trade with options, because it's a minefield. If you don't know what you're doing, it's a great way to lose money. But both of these financial advisories are run by professional traders and a whole team behind them, and they give you profitable buy and sell notifications so you know which stocks to trade with options. So if you want to check them out, click the links below. They're only $19 each, and they'll help you greatly. So why not check them out if you're interested in doing so. Anyway, I'm really grateful for you watching this challenge series. I hope it's helping you, and I'll look forward to seeing you in the next video.